So here we are, we're going to talk about saving Greece and the euro. This is an idea that I wrote up in a book called Jimmy Stewart is Dead. Jimmy Stewart is a former famous movie actor. He passed away many years ago now, but he is famous for many movies, including movies by Alfred Hitchcock, but also there's a famous Christmas movie called It's a Wonderful Life, in which he plays a banker in a small town. He has a small bank, and the bank experiences a run on the bank. It almost collapses, but because he knows everyone and everyone knows him, he's able to give a very persuasive speech and get everyone to keep their money in the bank rather than taking it out. But the movie, it's called, again, It's a Wonderful Life, is showing you the fragility of the banking system. It's showing you that leveraged banking is highly fragile. It's a banking system that's built to fail. And that's really what we're seeing in Greece. The big concern about Greece defaulting is that the Greek banks hold a lot of government debt, and if the Greek government were to default, the Greek banks would go under, and there would be a run on the banks in Greece, and they would have to stop operating, and two things would happen. You would have the lack of financial intermediation in Greece, and you could also have this bank run in Greece spread to other countries, where they also have banking systems that are highly leveraged. Even after the great financial crisis of 2007, 2008, the banks are still extremely highly leveraged. So they cannot withstand a run on them. And that's why we get so concerned when it comes around to talking about Greece defaulting on their debt. We get concerned really about the banks in Greece failing and there being a run on the banks that would spread to Italy and Portugal and Spain and Belgium and France and Germany and then to the United States and to China, all around the world, because these banks are all built to fail. They all have the potential to fail, and we saw multiple bank failures in 2007 and 2008. We saw about 28 big financial companies, and when I say banks, I include insurance companies like AIG and investment banks like Lehman Brothers and Bear Stearns. 28 major financial entities collapsed in the crisis because they were highly leveraged and they were built to fail. So if this were to happen in Greece, if they were to have their banks fail, the Greek government would have to try and start them up again, and the only way it could do that would be to print its own money, and that would involve going off the euro. So the connection between bank failures and the euro is very, very close, and indeed I think really the essence of the problem is a banking crisis in Greece. There's also an economic recession, depression in Greece, but the essence of the issue with respect to Greece defaulting is really one of a banking crisis. Now, what is Greece right now? Where are they? They're really stuck in economic hell. They have a never-ending Great Depression. It's marked by 25% unemployment. They've got far lower GDP right now than they had in 2007. It might be 25% lower. I'm not sure of the latest numbers. We've got nationalism, nationalistic tendencies, not just in Greece, but in Spain, other parts of Europe. The country has massive official government debt. It's been reported to be about 170% of GDP. There's this ongoing banking crisis, people taking their money out of Greek banks and putting their euros in other banks in Switzerland or in Germany. And they have tremendous fiscal uncertainty that they're living under, which is limiting investment. If the country is broke and it needs more revenue, then foreigners are not going to be, foreign companies and foreign governments are not going to be keen or eager to invest in Greece because they're not sure what the taxes will be like in the future if the country needs so much money. Now, Greece, to be honest, has actually already defaulted to a large extent on its debt. This 170% debt to GDP ratio, which is routinely reported by the press, is a book value, not a market value. The market value is really about 70% of GDP. Now, that's roughly the same market value as arises in the US in terms of the ratio of debt to GDP. So why is it that Greece, that the country of Greece and the European Central Bank and the German government, they're all misreporting the size of Greece's debt problem? Well, there's a reason. Greek politicians, if they continue to maintain that the Greek debt problem is much bigger than it actually is, they can continue to claim that Greece is broke, and they can keep asking for help, and they get more help. So it's in the interest of the politicians to continue to really lie about the situation, because that way they don't have to turn to the public and ask them for more sacrifices. They can just try and get more help from the European Central Bank or the European community. Now, the same kind of reasoning happens on the side of the European Central Bank, and that's largely dominated by the Germans. The German politicians can keep pretending that Germany hasn't lost money on its loans to Greece. The German politicians don't want to tell the German public that they have actually lost an amount of money equal to about 100% of Greek GDP, which is a lot of money. And they continue to, and the bureaucrats have no real interest in solving this problem, because they get to meet every few months, every 6 months at least, in very fancy resorts, and they get to save the day again for a few more months. And this has been going on. This movie continues to be played every 6 months for many, many years now, for 7, 8 years. So it works for the bureaucrats, it works for the politicians. It's not working for the people of Greece or for the future of the euro. Now, I think Greece needs to publicly default. I think this is going, if they publicly default on their debt, it will change external and internal perceptions of the future of the country. People will realize that their fiscal problem is in large part alleviated. It will eliminate fiscal uncertainty. It will help jumpstart the economy. It will help foreigners decide this is an okay place again to invest in. And it will also save the euro, because this process of maintaining a crisis in Greece on an ongoing basis is very dangerous for the continued existence of the euro. Because I just gave you a scenario under which Greece would default, they may be forced to default at some point in a way that will lead them to leave the euro, and then other countries may decide that's a good idea too. And it really is not an issue of the euro, it's really an issue of the way the banking system is set up in Greece, as I'll explain. So Greece really does need to default, and they need to do that very soon. Now, let me just point out that Greece's history of fiscal irresponsibility, if you like, or fiscal responsibility, depending on how you want to characterize it, its fiscal history was not unknown to the people that lent money to Greece. And they understood when they charged the interest rate for the loans that they did, that Greece might run into trouble again and not be able to pay as has been its history in the past, and as has been the history of many countries around the world who have defaulted in full or in part on their obligations. You can go back to the 1500s in Spain. They had a series of defaults. 1575, for example, was a big default by Francis, I think, the second of Spain. And you can go back to England in the 1400s. They were probably the first country to formally default on the debt. Now, when you charge a premium for the possibility that you are going to be defaulted on, and then the country has a Great Depression and has 25% unemployment, it's not surprising that you should be expecting to be defaulted on. That was partly the contract that you entered into. So I see nothing immoral about Greece defaulting at this point when they have got such a major economic problem. This was really implicitly part of the contract that they wrote when they made their loans, or when they borrowed the money initially. Okay. Now, I just went through the scenario under which Greek banks hold Greek government bonds. There's runs on the banks when they have these mini crises. The bank runs can spread through the Eurozone. And the deposit insurance that the ECB is kind of implicitly providing or explicitly is no real guarantee against runs, because were there to be massive runs on all the banks in the Eurozone, or most of the banks, or large numbers of banks, the European Central Bank would have to print lots and lots and lots of euros. That would give people the belief that there would be inflation. If you have your money in a bank in Germany and you think your bank is safe, but you see inflation coming, you want to get your money out of the bank to buy something like a computer or a bed or a car, something real, or some cans of soup. So the European Central Bank does not have cans of soup to guarantee nominal deposits with. All it can do is print money. And money, in case anybody has forgotten, money is paper. And this paper is worth, depending on the price level, can be worth very little. It's just paper. Everybody should realize that they should do this every so often just to remember what this stuff is. It's just paper. I think that might have been a small violation of U.S. law. It might preclude my running for president, but we'll see. Okay. So bank deposits are no guarantee against runs. Bank deposit insurance in my country, certainly not in Argentina, certainly not in countries that have periodically experienced very major inflation. It doesn't matter. So let's be clear, we have an issue about runs. We need to stop bank runs and before they shut down the financial intermediation system. When that happens, it destroys the payment system, it destroys commerce, it destroys a public good, which is the financial marketplace, the financial highway. And as I said, it would force Greece to exit the euro and print drachmas to reopen the banks. So the summary here is that Greece must default. It can't default without runs on its banks, the way the banks are currently set up. Saving the banks would require leaving the euro. And the ECB is terrified by the prospect of euro exit by Greece, which could spread to other countries, including ultimately the U.S. So we're also very concerned about it. That's why when there's a banking crisis, even in small Cyprus, it becomes front-page news in the New York Times because it's that fragile. It's just like in the movie It's a Wonderful Life. If Jimmy Stewart had not been there to save the day, there would have been a bank run on his bank that would have destroyed his bank. That's why I called my book about banking, Jimmy Stewart is Dead, to make clear that we don't have trustworthy bankers that we can rely on to give great speeches to save the day. We have to institute a banking system that actually preserves this public good, that doesn't gamble with the public good, that isn't built to fail, which is what we have in our banking system in this country, in your country, in my country, around the world today. So Let me just tell you how to fix this situation. We need to focus on the liability side of the balance sheets of banks. We need to restructure all the banks as mutual fund holding companies that do one thing only, and that is to market 100% equity financed mutual funds. So this is what's called limited purpose banking, and it's described in this book, Jimmy Stewart is Dead. And limited purpose banking limits the banks and other financial companies, corporations, to do one thing, which is their job. It's not to gamble with the financial system, the financial highway, which is a public good, the financial marketplace, that they're entrusted to be operating on an ongoing basis. Their job is just to financially intermediate. So rather than, if I'm a bank, rather than my coming to Kwon Do and saying, Kwon Do, let me borrow money from you and I'm going to buy some mortgages with it, and trust me, I'll pay you back. Instead, in a mutual fund, what happens is I come to Kwon Do and I say, Kwon Do, buy my shares to my mutual fund company. You give me some money, I'm going to give you back shares of stock to this mutual fund, and I'm going to take the money and I'm going to go buy mortgages. And if those mortgages that I buy are bad choices and they default, then what's going to happen is that the value of your shares is going to go down. But my financial intermediation company, my mutual fund, will not default. Now, in the U.S. in 2008, we had a lot of banks fail, very big banks fail, but we had no mutual fund holding company that was issuing equity financed mutual funds fail. There were back then, and there are roughly today, about 7,000 equity financed mutual funds. Not one of those mutual funds failed because they had no debt. They could not fail by definition. Now, there were 3,000 money market mutual funds, all of which were leveraged because they all promised to back the money they got from their, quote, shareholders to the buck. They promised, if I was running a money market fund, I went to Kwon Do and said, give me your money and I promise that you will never lose the principal of what you give me. So I'm going to issue some shares, but I'm also going to make an extra promise, which is to back that money to the buck, to pay you for sure at least what you put in to my fund. Well, they had no ability to guarantee that, and they got into trouble, and they had to be insured by the federal government in a major act by the U.S. Treasury and the Federal Reserve. So there was a big run on the money market mutual funds, but over time we've changed the rules now in the U.S. so that most of the money market funds are also not back to the buck or not leveraged. So right now today we have 10,000 individual mutual funds, very few of which are really leveraged. Almost all are equity financed. They hold about 30% of the financial assets. This is limited purpose banking, with one exception, which is limited purpose banking also requires full disclosure by the government of what the mutual fund is holding. So if I'm buying mortgages under limited purpose banking, the government would verify the mortgages. So I wouldn't be buying mortgages and lying to you, Kwon Do, about the mortgages that I'm buying. I wouldn't be engaged in liar loans and no-doc loans and what are called ninja loans. The government would be verifying that this guy I'm making a mortgage to actually has a job, actually pays his taxes, actually earns the money that he says he's earning. And the government's in a very good position to verify that because the government gets income tax returns, and also would verify the value of the house that he's buying. So this verification of the assets of mutual funds can be done very straightforwardly by the government. We can go from a system of having like 150 regulatory bodies to having one regulatory body, which I call the Federal Financial Authority, which would regulate, which would verify, do one thing only, which is to verify all the securities that the 10,000 mutual funds are issuing or are buying in my country. And then if we did this in Korea, it would be the mutual funds that are operating in Korea. So this is a way, if Korea were to adopt limited purpose banking, you would never have another Asian crisis. You would not have had an Asian crisis back in the 1990s, late 1990s, when you did have a crisis. We would not have seen in the U.S. 8.5 million people put out of work over the course of 19 months after Lehman Brothers went under. We would have perhaps had a housing bubble or not, but it would not have led to a financial panic and crisis, which is what happened. So there is an answer, and this is the answer for Greece. We need to transform the Greek banks into mutual fund holding companies so that the people that want to hold Greek government bonds would do so through these mutual funds that would be holding Greek government bonds. Other Greeks would be holding mutual funds that buy mortgages. Yet other Greeks would be holding mutual funds that hold just cash. I call those cash mutual funds, and they would be used for the payment system. And of course, some Greeks would have some of all these types of mutual funds. Some would be investing in mutual funds that invest in Greek stocks. Others would be invested, and they would also hold Greek mutual funds that invest in European stocks or U.S. stocks. Again, we have 10,000 of these things operating in the U.S. We could also run derivatives through equity finance mutual funds. So we don't need to have traditional derivatives being operated in a way that can bring down the financial system. So, for example, if I'm trying to sell a CDS, which is an insurance for bonds, the way I do that is I come to you three gentlemen. I set up a mutual fund that is going to insure against Deutsche Bank bonds failing. And two of you gentlemen, let's say, give me money and you invest on horse A. Think about this as a horse race. You give me some money and you're betting on horse A, and you give me some money and you're betting on horse B. And this race takes place over 3 months. At the end of the 3 months, horse A is that Deutsche Bank bonds have defaulted after 3 months. Horse B is that they have not defaulted. So after 3 months, we take a look. If horse A wins, I take a little bit of that money out as a fee. I give all the money that you guys gave me to you two people, and you now, in proportion to what you put in, you now have been insured against Deutsche Bank's bonds failing, and you've lost the bet. But that is a credit default swap market right there. That's a derivatives market with no risk to anybody outside of the three of you. It's a closed-end pari-mutuel fund. It was started in 1857. It happens every day in the racetracks around the world. It's a safe way to run bets. And the mortgage mutual funds, equity finance mortgage mutual funds, were started back in 1795 by Frederick II in Denmark. So there's a long history. They're called covered bonds. The covered bond system has been operating in Denmark and Sweden and northern Germany for centuries, really. It's a equity finance mutual fund system that invests in mortgages. So there is a solution. We need to transform the Greek banks into 100% equity finance mutual funds. We can do that very simply by telling the Greek banks, listen, folks, at the margin, you can only do one thing, which is you can issue 100% equity finance mutual funds. You can't do any other type of business at the margin. And your existing business, you can manage those assets, you can manage the liabilities you now have, but you cannot borrow any more money and invest it at risk. The only thing you can do is set up equity finance mutual funds. And very quickly over time, the Greek banks will be transformed into these mutual fund holding companies. And then if Greece needed to default on its government bonds, the banking system, the financial intermediation system would remain intact. Yes, the people that had invested in mutual funds that were investing in Greek government bonds would lose money, but that's the nature of a risky investment. So there is a way for Greece to default on its debt, which does not collapse its financial system, that does not require it to go off the euro, that has nothing, there's really intrinsically no connection between Greek government bond default and being on the euro. They just don't go together. It's only because the banking system is set up the way it is, it's set up in a way to fail, that there is this connection. So let me now turn to a quite different topic, which is, anyway, just to summarize, the real problem with the banking system are these two things, leverage and opacity. The limited purpose banking proposal fixes both. And I now want to turn to, and it deals with all these other problems in the existing financial system: fraud, insider rating, director sweetheart deals, corporate governance problems, political bribes, regulatory capture, moral hazard, non-disclosure, off-balance sheet bookkeeping, government bailouts, and failure to mark-to-market. All those problems go away with limited purpose banking. It's a very simple idea, and it's been endorsed by many Nobel Prize winners, by many top economists who haven't yet won the Nobel Prize, by people like George Shultz, who's the former Treasury Secretary of the United States. So every country, including Korea, needs to adopt limited purpose banking.